John Berlau. He's the Senior Fellow for Finance and Access to Capital for the Competitive Enterprise Institute. John, we welcome you to America's Forum. And as I hear this and reminisce on my days on the Ways and Means Committee, so often we talk tax reform, but basically we're talking tax reductions, right? I mean, mindful of Milton Friedman's admonition, if you want less of something, tax it. The inverse would be true. If you want more activity economically, you drop the taxes and invite the corporations back into the U.S.
Yes, tax reform has to involve reduction, Congressman Hayworth. The Caterpillar is just one of many because it's both. The code is both so convoluted and the corporate tax rate is so high at 35%. And the fact that we're one of the few countries in the world that has that complete as high a corporate tax on foreign earnings, what our companies, earn in Europe and Asia, the U.S. taxes, plus they get taxed by those countries as the corporate tax in the U.S. So it actually creates a perverse incentive to keep those profits and reinvest overseas rather than bring it back here.
So we take a look at what happens, and indeed you look at the corporate tax codes, and the United States with a 39.13% rate in 2012, leading the industrialized world. I want to drill down some on the reform that pairs with the reductions. We just heard the Caterpillar those notions look like under the rubric of tax reform?
Well, unfortunately, and you're right, Dave Camp's tax reform plan that's being discussed now, does lower the corporate tax rates. It also gets rid of the territorial tax, the worldwide taxes, and makes it a territorial system. But it raises some taxes on small businesses, on small business partnership, like the carried interest tax for interest, which would a lot of partnerships from small firms to venture capital corporations would have to pay more, and then there would be less beneficial economic activity for growth. But I think changing the U.S. system to just where worldwide, where what is earned here is taxed, and what a company earns in foreign countries is only taxed by those countries, would both simplify and create economic growth, and you wouldn't have to create foreign sales tax credits to offset the VAT and all the taxes in Europe, because the U.S. just wouldn't be taxing those earnings at all.
Let's talk just a little bit. I know our focus has been on corporations, but I'm interested in individuals right now. Given where we are in terms of our corporate tax code in the United States, does our current code prevent wealthy people from moving to the United States and taking up residence here?
I'd say yes. I'd say both the tax code and and don't forget the regulations. I mean, regulations are we have trillions of dollars in regulatory costs. They're like hidden taxes. At CEI.org, we just have something called 10,000 Commandments by my colleague Wayne Cruz. It talks about all of the regulatory costs. So you get all of that combined, and yes, you're creating a disincentive for the most productive people coming here and for people creating here.
John, only about a half a minute left. If there is one thing you want to see done more than anything else to make the U.S. competitive internationally in this regard, what would that one thing be?
Give Congress no regulation without representation. You have Congress vote on the regulations from Dodd-Frank and Obamacare that are issued, just like they vote on laws.
Well, you know what? That sounds like a bill I introduced years ago working with our friend Mr. Cruz as an advisor back in the day, the Congressional Responsibility Act, and I appreciate you bringing that up because regulations are another form of taxation. John Berlau of the Competitive Enterprise Institute, we thank you for your insight. Francesca, we thank you for your reporting. And as they say on a certain ad, I used to resemble that remark. There's more coming up on America's Forum. Stay with us.